Hello students, welcome to the lecture on journal and ledger. And after the lecture, we will be able to learn the following objectives. Explain the concept of journal, define the rules of debit and credit, understand the compound journal entry and subsidiary books, discuss the ledger and the rules regarding posting. Explain the trial balance. Let's start with a brief introduction. The journal details and all the financial transactions of a business and which accounts these transactions affect. Typically, journal entries are entered in chronological order and debits are entered before credits. In accounting, a journal refers to a financial record kept in the form of a book, spreadsheet, or accounting software that contains all the recorded financial transaction information about a business. An accounting journal is created by entering information from receipts, sales, tickets, cash register tapes, invoices, and other data sources that show financial transactions. Business transactions should be recorded so that they can be presented in the journal in chronological order. Before computers, an accounting journal was a physical logbook with multiple columns to record financial transactions for a company. Today, most businesses use soft type of financial accounting software to record and manage their business transactions. These transactions are then assigned to a specific ledger class using a chart of accounts numbers to prepare profit and loss statements, financial statements, and other important financial reports. All business transaction is initially recorded in a journal using the double entry method or single entry method of bookkeeping. The journal records all daily transactions of a business in the order in which they occur. A journal may therefore be defined as a book containing a chronological record of transactions. It is the book in which the transactions are recorded first of all under the double entry system. Thus, journal is the books of original records. The process of recording transaction in a journal is termed as journalizing.
Welcome to Introduction to Debits, Credits, the Journal, and the Ledger. Let's get started. The first thing we need to do is define two key terms. The first term is debit. Debit simply means left. The second term is credit, and credit simply means right. Many students start studying accounting with preconceived notions about the meanings of the words debit and credit. These notions come from interactions with banks or credit card companies. It's best to forget those preconceived notions and accept that debit means left and credit means right. The next thing we want to do is to understand three key rules when working with debits and credits. The first rule is that the total amount of debits must equal the total amount of credits. Another way to think of that is that debits are equal to credits. The second rule is that we need to understand the accounts that increase with debits. The accounts that increase with debits are dividend, expense, and asset accounts. Again, accounts that increase with debits are dividend, expense, and asset accounts. The third rule determines the accounts that increase with credits. The accounts that increase with credits are liabilities, equities, and revenue. Looking at it another way, if we take the first letter of each of the accounts that increase with debits, we have DEA, and then the accounts that increase with credits, we have LER. So we have an acronym to help us remember. Dividend, expense, and asset accounts increase with debits. Liability, equity, and revenue accounts increase with credits. Next, we want to look at the journal. The journal is a chronological list of all economic events that are recorded in the accounting records. The journal includes the date of the transaction, the account names affected by the transaction, the amount debited to each account, and the amount credited to each account. In addition, the journal includes a description of the transaction. Taking a closer look, we see a sample journal. It includes the date, the account name, debit, and credit. So if we recorded a journal entry that occurred on 9/3 of year 1, we see a debit to the account cash in the amount of $100, a credit to sales revenue in the amount of $100. Our description is we received $100 from a customer for the sale of merchandise. We know exactly the economic event that took place, and we see the accounting transaction that recorded this economic event. Our next journal entry happened on 9/3 of year 1, and we see supplies being debited for $70 and accounts payable being credited for $70. The description is we purchased $70 worth of supplies on account. The economic event that occurred was the purchase of $70 of supplies on account. The accounting transaction that recorded this economic event was to debit supplies $70 and to credit accounts payable $70. The final economic event that we're going to look at happened on 9/5 of year 1. Here we see a debit to accounts payable of $70 and a credit to cash for $70. We see that we paid for supplies purchased on account. One thing to notice in our journal is that we always write the accounts that are debited before we write the accounts that are credited. That's just a convention that is used by accountants. Remember, the journal is a chronological list of all economic events recorded in the accounting records. The journal includes the date, the account names, the amount debited to each account, and the amount credited to each account, as well as a description of the transaction. Reviewing the journal, we see a date, account name, the amount debited, the amount credited, and a description for each transaction recorded in the journal. Next, we want to take a careful look at the ledger. The ledger groups all of the transactions affecting a particular account together. The ledger reports the account balance, and a T account is a way to conveniently represent the ledger. So let's take a more careful look at the ledger. The ledger includes an account name as well as a balance. The debit and credit columns are still there, as well as a description. So here we see a cash ledger. A ledger differs from a journal in that only the part of the transaction affecting cash is written in the ledger. Here we see the cash ledger where we received cash from a customer of $100. Then on 9/5, we paid for supplies purchased on account for $70. We also see in the far right-hand column, we have a zero starting balance, a $100 increase in the balance when we receive cash from the customer, and a $70 decrease in the balance when we pay for supplies that are purchased on account. The debit in the cash account represents an increase in cash. The credit to the cash account represents a decrease in cash. Both journals and ledgers are included in a set of accounting records. Here we see an accounting record for accounts payable. Accounts payable has an opening balance of 0. It has an increase in the accounts payable account with a credit of $70. And then on 9/5, we paid for the supplies that we purchased on account, which decreased the liability accounts payable by $70. So our ending balance in accounts payable is 0 after we make that payment.
Moving on further, let's discuss in brief the concept of journal. The word journal has been derived from the French word jour. Jour means day, so journal means daily. Transactions are recorded daily in journal and hence it has also been named so. It is a book of original entry to record chronologically, that is, in order of date and in detail the various transactions of a trader. It is also known as daybook because it contains the accounts of everyday transactions. A journal includes all accounting transactions and is considered the historical record for a business entity. All transactions must be recorded through a journal entry that provides specific instructions in a line-by-line sequence. Each line names a specific account and an amount designated as a debit or a credit function to be posted to each named account. Three requirements characterize journal entries. The journal entry must identify at least two accounts. The journal entry must show at least one debit and one credit entry. And the sum of the debits and credits must be equal. Each business transaction must be analyzed to determine the effects of increasing or decreasing an asset, liability, owner's equity items, sales revenue or expense accounts. It is incorrect to view debits as increases and credits as decreases in the balance of all ledger accounts. All accounts are referred to as being normally debit or credit balanced based on their classifications. Closing journal entries. The general ledger showing the posted operating and adjusting journal entries is shown for review. The general ledger is the source used to prepare an adjusted trial balance that confirms the ledger accounts are in balance. The benefits. The journal covers a broad scope of areas related to financial reporting and accounting. It provides an interdisciplinary and international understanding of theory and practice in a variety of fields. It also keeps abreast with the development and advancement of accounting knowledge in financial reporting and accounting internationally. The characteristics of a journal. The journal has the following characteristics. Journal is the first successful step of the double entry system. A transaction is recorded first of all in the journal, so the journal is called the book of original entry. A transaction is recorded on the same day it takes place, so journal is called daybook. Transactions are recorded chronologically, so the journal is called chronological book. For each transaction, the names of the two concerned accounts, indicating which is debited and which is credited, are clearly written in two consecutive lines. This makes ledger posting easy. That is why a journal is called assistant to ledger or subsidiary book. Narration is written below each entry. The amount is written in the last two columns, debit amount in debit column and the credit amount in the credit column. The advantages of journals are, each transaction is recorded as soon as it takes place, so there is no possibility of any transaction being omitted from the book of accounts. Since the transactions are kept recorded in the journal chronologically with narration, it can be easily ascertained when and why a transaction has taken place. For each and every transaction, which of the two concerned accounts will be debited and which account credited are clearly written in the journal, so there is no possibility of committing any mistake in writing the ledger. Since all the debits of transactions are recorded in the journal, it is not necessary to repeat them in the ledger. As a result, the ledger is kept tidy and brief. Journals show the complete story of a transaction in one entry. Any mistake in the ledger can be easily detected with the help of the journal. Let's now look at the rules of the debit and credit. Under the double entry system, every financial transactions of a business have a double effect. That is, each transaction involves at least two accounts. One aspect of the transaction is debited in an account and the other credited in another account. The debiting and the crediting of the two accounts are done on the basis of certain rules. These rules are called the rules of journalizing, that is, debit and credit. There are two alternative bases for the rules of debit and credit. Rules of debit and credit based on the types of account, the rules and debit that are based on the accounting equation, the rules of debit and credit based on the type of account. Under double entry system, an account is classified into three types. They are personal accounts, real accounts and nominal accounts. For each of these types of accounts, there are three separate rules of debiting and crediting the financial transactions. Personal accounts. Personal accounts is an account of a person. A person can be a natural person such as people like us, an artificial person such as firms, organizations and institutions, and a representative person such as debtors and creditors. Since a person, be it a natural or an artificial representative, can be the receiver of benefits or giver of benefits. The rule of debiting and crediting the account of the person is as follows. Debit the receiver of benefits, credit the giver of benefits. This rule states that whenever a person receives benefits is debited by the amount of the benefit received. On the contrary, whenever the person gives the benefits is credited by the amount of benefits given. Real accounts. Real account is a record of an asset. An asset can be current assets such as cash, a fixed asset such as building, and an intangible asset such as goodwill. Since an asset is a current, fixed, or an intangible asset, can either come into the business through its purchase or go out of the business through its sales, the rule of debiting and crediting the real asset account is as follows. Debit what comes in, credit what goes out. This rule states that whenever some benefit in the form of asset comes into the business through its purchase, its asset account is debited. Conversely, when some benefit in the form of asset goes out of the business through its sales, its asset account is credited. Nominal accounts. Nominal account is a record of expense or loss or income or gain. An expense or loss is the sacrifice of benefits in exchange for service used, and an income or gain is the benefit earned in exchange of services rendered. Since the business makes expenses and earns income, the rule of debiting and crediting the expense and income nominal account is: debit all expenses and losses, credit all incomes and gains. This rule states that whenever some benefit is sacrificed in exchange for services used, expenses made or loss suffered, its expense account is debited. On the other hand, whenever some benefit is earned in exchange for service rendered, its income or gain account is credited. The rules of debit and credit based on the accounting equation. Accounting equation is a statement of equality between the three basic elements of accounting. They are assets, capital, and liabilities. Each and every financial transaction affects the three basic elements. However, the total of all assets is always equal to the total of capital and liabilities at any point in time. Accounting transactions, the rules of debits and credits. In all fairness, debits and credits are not that difficult to understand. It is simply that due to the nature of the materials, debits and credits, every transaction in accounting is either debit or a credit. How simple is that concept? Everything is recorded in a financial manner is either a debit or a credit. The abbreviations for debit and credit are DR and CR respectively. Debits are a component of an accounting transaction that will increase assets and decrease liabilities and equity. Credits are a component of an accounting transaction that will increase your liabilities and equity and decrease your assets. Maybe we can put this into a simpler format. Credits increase liabilities and equity, credits decrease assets. Debits decrease liabilities and equity, in debit increases assets. If it will simply make a chart with the information above, it should easily be able to discern which transactions are credit or debits for which accounts. That being said, let us take a look at the basic rules when recording debits and credits. For each transaction, there are at least two accounts affected, one with a debit and one with a credit. Every financial transaction credits one account and debits the other.
We will now go more in depth into these transactions and learn how they affect different accounts and how to apply the rules of debit and credit in different situations. The accounts kept by a business depend upon the nature of its operation and the types of transactions it carries out. A business may hold numerous accounts which record and sort the different transactions that are conducted by the business. Before a business starts recording transactions, it sets up a chart of accounts in which different transactions are recorded. We earlier learned that these accounts can be classified as balance sheet or income statement accounts. Under balance sheet accounts, the key accounts are assets, liabilities, and owner's equity. Under income statement accounts, the key accounts are revenue and gains and expenses and losses. Within each of these accounts, there will be several accounts for different items such as cash, inventory, machinery, etc. Let's take a brief look at these accounts. The three balance sheet accounts are shown on screen. As you can see, the common types of asset accounts include cash, accounts receivable, equipment, inventory, and prepaid expenses. Note that these are just examples of asset accounts. The accounts receivable refer to the money that you expect to receive from other businesses or individuals. In reality, there will be many asset accounts. Common types of liability accounts include accounts payable, notes payable, unearned revenue, deferred taxes, long-term debt, and so on. The accounts payable refer to the money that a business owes to other businesses or individuals. Notes payable is the money that a business promises to pay at a future date, and the unearned revenue is the money received in advance. The common types of owner's equity accounts include capital and retained earnings. The capital account includes both the money invested by the owner and the money withdrawn for personal use. The retained earnings account represents the portion of net income retained by the business. The two income statement accounts are shown on screen. As you can see, within the revenue account, there is one main account for revenue. This is where the company's primary revenue is recorded. Apart from that, there can be other accounts for items such as dividend and interest earned, money earned from sale of assets, capital gains, etc. However, there will be many expense accounts representing different expenses incurred by the business.
Moving on further, our next topic is compound journal entry. A compound journal entry is an accounting entry which affects more than two account heads. A simple journal entry has one debit and one credit, whereas a compound journal entry includes one or more debits and or credits than a simple journal entry. A compound journal entry may combine two or more debits and a credit, or a debit and two or more credits, or two or more of both debits and credits. A compound entry is simply a combination of two or more simple journal entries, but instead of recording numerous simple journal entries, it is better to record journal entries of single accounting event as a compound entry because it saves time and keeps related debits and credits in one place. Subsidiary books. Subsidiary books are special journals or ledgers where the first or the original transaction entries are made before being posted into their respective accounts. They are referred to as subsidiary books because they are separate books which categorize income and debits into their proper areas before they are added into the principal or the main books. The journal entry made into the primary record acts as a source of information to be used in building specific final accounts in bookkeeping. The primary records have many names that include prime book of entry, books of original entry, primary records, and many others that depict their function. The most common types of subsidiary books of accounting include a purchase book, which is used to record all credit purchases done, a sales book that shows all of the credit sales, and a BASH which records all cash received and paid. A purchases returns book records all of the purchases that have been returned to the supplier, as well as sales return book that indicates all the sold items returned. There is also a bills receipt books which shows all the bills paid, along with the bills payable books that shows all the bills paid, such as electricity. The final books are main journals or journal proper subsidiary books that do not require entry into mini journals. There are many advantages of using different subsidiary books for varying entries rather than having them in only one journal. The first advantage is that it helps keep the records brief. It is impossible to manage every single transaction in the main ledger as it occurs. Another advantage of using the subsidiary books of accounting makes it easy to track transactions and avoid the cluttering that would occur if all of the different information was in one place. The separated information saves the need to give extended details of the transaction and makes future references easy and simple. The primary records are classified according to the nature of the transactions. The third advantage is that the subsidiary books reduces cases of fraud. The journal entries are done in chronological order, meaning that the dates follow each other and it involves detailed postings to other accounts. What this means is that it is almost impossible to manipulate all the books involved, but if it is done, the detection is quite simple. Subdivision of a journal. Though the principle of journalizing all transaction known as continental system of bookkeeping is quite perfect in actual business, but in a large business it is found inconvenient to journalize every transaction, and sometimes it becomes rather impossible for one man to journalize numerous transactions on a business in one journal. Therefore, the journal is subdivided into different journals known as subsidiary books or books of prime entry or books of original entry. These are the books in which are recorded the details of transactions as they take place from day to day in a classified manner. Difference between a simple and a compound journal entry. Business managers and accountants commonly use double entry bookkeeping to record business transactions and compose financial statements. Journal entries are initial records of the day-to-day transactions that a manager records. This journal data is then generally used to construct general ledger entries and more complex reports such as quarterly or annual financial statements. How many accounts are affected by the transactions entered determines whether the information is deemed a simple or a compound journal entry. The general journal in basic. In basic accounting, the journal is often called the book of original entry. It is this book in which daily transactions are recorded as simple or compound in the chronological order that each occurs. Later, the accountant or business manager transfers the information from this original entry book, the general journal, to one or more account ledgers. Standard procedures dictate that debits are recorded on the left and the credits on the right. This makes later transfer of the information easier. Double entry journaling. Double entry bookkeeping requires that for every debit entered into the records, a corresponding credit is also recorded. Ledger. After journalizing transactions, the next step in the accounting process is to post transactions to the accounts in the general ledger. Although the accounts provide a conceptual framework for understanding accounts, most businesses use a more informative and structured spreadsheet layout. A typical account includes date, explanation, and the reference columns to the left of the debit column and a balance column to the right of the credit column. The reference column identifies the journal page containing the transaction, posting journal entries to the ledger accounts. The second step of accounting cycle is to post the journal entries to the ledger accounts. The journal entries recorded during the first step provide information about which accounts are to be debited and which to be credited, and also the magnitude of the debit or credit. See debit credit rules. The debit and credit values of journal entries are transferred to the ledger accounts one by one in such a way that debit amount of a journal entry is transferred to the debit side of the relevant ledger account and the credit amount is transferred to the credit side of the relevant ledger account. After posting all the journal entries, the balance of each account is calculated. The balance of an asset, expense, contra liability and contra equity account is calculated by subtracting the sum of its credit side from the sum of its debit side. The balance of a liability, equity and contra asset account is calculated by the opposite way, that is by subtracting the sum of its debit side from the sum of its credit side. Trial balance. Students, what do you understand by the term trial balance? The various debit balances and the credit balances of the different accounts are put down in a statement which is termed as a trial balance. In other words, trial balance is a statement containing the various ledger balances on a particular date. A trial balance is a list and total of all the debit and credit accounts for an entity for a given period, usually a month. The format of the trial balance is a two-column schedule which all the debit balances listed in one column and all the credit balances listed in the other. The trial balance is prepared after all the transactions for the period have been journalized and posted to the general ledger. The key to preparing a trial balance is making sure that all the account balances are listed under the correct column. The appropriate columns are assets equals to debit balance, liabilities that is equal to credit balance, expenses that is debit balance, equity equals to credit balance, revenue equals to credit balance. Trial balance prepared. The trial balance is prepared to check or ensure the arithmetical accuracy of accounting. Though not a conclusive proof, the agreement of the trial balance is a prima facie evidence of the absence of mathematical errors. This is the most important purpose for which the trial balance is prepared. Is not trial balance made for enabling preparation of final accounts? Preparation of trial balance is not an act that forms a part of the activities involved in the regular accounting cycle. Since final accounting can be completed without the preparation of the trial balance, we can say that enabling the preparation of final accounts is not the purpose of the trial balance. The trial balance is generally prepared at a time when all the ledger accounts are balanced, like at the end of the accounting period. Theoretically, the trial balance can be prepared as and when needed. Different ledger accounts are balanced at different time intervals based on the information needs of the organization. Final accounting. Use of journal or ledger. Final accounting deals with all the ledger account balances at the end of the accounting period, in one way or the other. All the nominal accounts that represent direct expenses and direct incomes are closed by transfer to the trading account. For this, at least two journal entries are recorded. The trading account is closed by transferring its balance to the profit and loss account. For this, a journal entry is recorded. All the nominal accounts that represent indirect expenses, losses and indirect incomes are closed by transfer to the profit and loss account. For this, at least 2 journal entries are recorded. The profit and loss account is closed by transferring its balance to either the capital account or the profit and loss appropriation account. For this, a journal entry is recorded. All the remaining accounts are listed out in the balance sheet. Now, in the end, let us summarize what we have learned in this lecture. In accounting, a journal refers to a financial record kept in the form of a book, spreadsheet or accounting software that contains all the recorded financial transaction information about a business. An accounting journal is created by entering information from receipts, sales tickets, cash register, tapes, invoices and other data sources that show financial transactions. A journal includes all accounting transactions and is considered the historical record for a business entity. A compound entry is simply a combination of 2 or more simple journal entries, but instead of recording numerous simple journal entries, it is better to record journal entries of single accounting event as a compound entry because it saves time and keeps related debits and credits in one place. Subsidiary books are special journals or ledgers where the first or the original transaction entries are made before being posted in the respective accounts. The various debit balances and the credit balances of the different accounts are put down in a statement which is termed as a trial balance.